Hey there, America. Let's talk about something as exciting as watching paint dry the Federal Reserve, or as the cool kids call it, the Fed. Now, I know what you're thinking. Why should I care about the Fed? Well, buckle up, because this seemingly dull institution has a huge impact on your daily life. Now, the Fed is like your weird distant uncle who pops in every now and then to mess with the thermostat of the US economy. Imagine you're at a family gathering and suddenly Uncle Fed decides it's too cold and cranks up the heat. Everyone feels the change, right? That's pretty much what happens when the Fed adjusts interest rates. They don't print money. That's a different branch of weirdness, but they do control how much it costs to borrow money. This is crucial because borrowing costs affect everything from buying a house to starting a business. When the Fed tweaks these rates, it's like they're adjusting the economic thermostat. Think of it like this. The Fed sets the interest rate, which is basically the price tag on loans. If you want to buy a car, a house, or even start a new business, the interest rate determines how much extra you'll pay for the privilege of borrowing that money. When they lower this rate, loans become cheaper. This means more people can afford to borrow money, whether it's for a new home, a car, or expanding a business. Lower rates can stimulate economic activity by making it easier for people to spend and invest. This entices people to borrow more, businesses to invest more, and voila, the economy gets a little jump start. Think of it as giving the economy a shot of espresso. Suddenly there's more activity, more jobs, and hopefully more prosperity. But hold your horses. It's not as simple as it sounds. Lowering interest rates can also lead to inflation, which is when prices for goods and services rise. So while borrowing might be cheaper, the cost of living could go up. The Fed doesn't just randomly fiddle with rates. They analyze a ton of data, from employment numbers to inflation rates, to make informed decisions. It's a balancing act, trying to keep the economy stable without letting it overheat or freeze up. They're like economic wizards, or at least they like to think so, trying to keep the economy from going off the rails. They use their magic to influence economic conditions, aiming for a stable and healthy economy. So the next time you hear the Fed cut rates, remember, it's not just some boring financial news. It's a strategic move that can affect your mortgage, your savings, and even your job prospects. It's your weird uncle messing with the economy's thermostat, and trust me, we're all going to feel the heat, or lack thereof. Whether it's making borrowing cheaper or more expensive, the Fed's decisions ripple through the economy, touching every aspect of our financial lives. So, next time you hear about the Fed, give a nod to Uncle Fed and his economic thermostat. He's got a tough job, and we're all along for the ride. All right, folks, let's break down this whole rate cut thing. It's a topic that can seem a bit complex, but we're going to simplify it for you. Imagine the economy is like a car. Stay with me here. Just like a car needs fuel to run, the economy needs money flowing through it to keep moving. When the Fed cuts rates, it's like stepping on the gas pedal. Lower interest rates make borrowing cheaper, encouraging businesses and consumers to spend more. They're trying to make the economy go faster, boost spending, and avoid a recession. More spending means more demand for goods and services, which can help businesses grow and hire more people. Why? Well, sometimes the economy gets a little sluggish. This can happen for various reasons, such as a decrease in consumer confidence or external shocks like a global pandemic. People aren't spending enough, businesses aren't investing, and things start to slow down. This can lead to higher unemployment and lower economic growth. That's when the Fed steps in with its trusty rate-cutting tools. By lowering interest rates, they aim to make borrowing cheaper, which can stimulate spending and investment. Now you might be thinking, why not just keep rates low all the time? It seems like a simple solution to keep the economy always running smoothly. More gas, more speed, right? Well, not so fast. Just like driving a car, there are risks involved with going too fast for too long. You see, if you keep your foot on the gas pedal for too long, the engine might overheat. In economic terms, that's inflation, where prices rise too quickly. In economic terms, that's inflation. When inflation gets too high, it can erode purchasing power and create uncertainty in the economy, so the Fed has to be careful. They need to balance stimulating the economy with keeping inflation in check. They need to find that sweet spot where the economy is growing at a healthy pace without prices going haywire. This balance is crucial for long-term economic stability. It's a delicate balancing act, kind of like trying to parallel park a clown car. Too much or too little of either can lead to problems, so the Fed's job is to steer the economy carefully. Lower rates can also help individuals and small businesses by reducing the cost of loans and mortgages, making it easier to finance big purchases or expand operations. This can lead to more home buying and construction, which in turn creates jobs and stimulates further economic activity. When people feel confident about their financial situation, they're more likely to spend money on dining out, traveling, and other activities that keep the economy vibrant. It's all interconnected. The Fed's decisions on interest rates ripple through the economy, affecting everything from individual spending habits to global financial markets. And remember, the US economy doesn't exist in a vacuum. Changes in interest rates can impact global trade and investment, influencing economies around the world. So the next time you hear about a rate cut, you'll know it's not just a dry financial term. It's a powerful tool that helps steer the economy, aiming for that perfect balance between growth and stability. And when it works, it can lead to a thriving economy where businesses prosper, jobs are plentiful, and people feel financially secure. That's the goal, and it's why these decisions matter so much. So the Fed has slashed rates. What does that mean for you, the average Joe or Jane sipping coffee and scrolling through this essay? Well, let's start with the good news. Remember that loan we talked about? Yeah, that car loan you've been eyeing or that mortgage you're trying to refinance. They just got a whole lot cheaper. Lower rates mean banks can offer loans at lower interest rates, making it easier for you to borrow money. This can be a game changer if you're looking to make a big purchase or consolidate debt. But it's not just loans. Rate cuts can also give the stock market a little boost, as businesses are more likely to invest and grow when borrowing is cheaper. So your 401k might even crack a smile. However, it's not all sunshine and rainbows. There's a flip side to this coin, and we'll get to that in a bit. Okay, so we've covered the immediate effects of rate cuts. We've seen how they can stimulate economic activity by making borrowing cheaper and encouraging spending and investment. But what about the long-term impact on the economy? That's a question that requires a deeper dive. But what about the long-term impact on the economy? How do these rate cuts shape the future landscape of our financial world? Well, that's where things get a little trickier. Remember our car analogy? Rate cuts are like stepping on the gas pedal. It gives the economy a quick boost. But if you keep your foot on the pedal for too long, you're going to run into some problems. Rate cuts are like stepping on the gas pedal. It gives the economy a quick boost, but if you keep your foot on the pedal for too long, you're going to run into some problems. Just like a car can overheat or run out of fuel, the economy can face its own set of challenges. It gives the economy a quick boost, but if you keep your foot on the pedal for too long, you're going to run into some problems. One of the biggest risks is inflation. When interest rates are low, people tend to borrow and spend more, which can lead to higher demand for goods and services. One of the biggest risks is inflation. When interest rates are low, people tend to borrow and spend more, which can lead to higher demand for goods and services. This increased demand can push prices up, eroding the purchasing power of your hard-earned dollars. When interest rates are low, people tend to borrow and spend more, which can lead to higher demand for goods and services. This increased demand can push prices up, eroding the purchasing power of your hard-earned dollars. In other words, your money doesn't buy as much as it used to. This increased demand can push prices up, eroding the purchasing power of your hard-earned dollars. In other words, your money doesn't buy as much as it used to. This can be particularly challenging for those on fixed incomes or with limited financial flexibility. In other words, your money doesn't buy as much as it used to. Another potential downside is asset bubbles. When money is cheap, investors are more likely to take risks, pouring money into stocks, real estate, or other assets. Another potential downside is asset bubbles. When money is cheap, investors are more likely to take risks, pouring money into stocks, real estate, or other assets. This can lead to inflated asset prices, creating bubbles that eventually burst, causing economic havoc. When money is cheap, investors are more likely to take risks, pouring money into stocks, real estate, or other assets. This can lead to inflated asset prices, creating bubbles that eventually burst, causing economic havoc. Remember the housing crisis of 2008? This can lead to inflated asset prices, creating bubbles that eventually burst, causing economic havoc. Remember the housing crisis of 2008? That was a prime example of what can happen when asset bubbles burst. Remember the housing crisis of 2008? That was a prime example of what can happen when asset bubbles burst. The aftermath was devastating, with millions losing their homes and jobs and the economy taking years to recover. Yeah, let's not go there again. It's crucial to find a balance when it comes to rate cuts. While they can provide much-needed economic stimulus, they must be managed carefully to avoid long-term negative consequences. Policymakers need to be vigilant and ready to adjust rates as needed to maintain economic stability.